Good afternoon, welcome to our live webinar. If you just let me know that you can hear me before we do start, if you can just write something into your question box, say hello, absolutely anything, so I can just make sure that you can see my screen and you can hear me coming out of your speakers. Hi Steve, how you doing? Hi Mohammed, hi Vinay, Ian, yep, I think everyone can hear me. Benzies, Paul, hello Ollie, Mark, Jay, Davor, Dion, John, Colleen, Chris, Peter, Alan, Reese, Gordon, Ronald, Philip, David, Neil, Antonio, Sally, Simon, Thomas, Peter. Good stuff. I think you can hear me. Good stuff. So we'll start with the webinar. My name's Michael Baker, and today we're going to be looking at trading post ESMA. The webinar is live, so you can ask any questions at any time. I've got my colleagues will be answering the questions on your that you do type into the comments, and at the end I'll be going through some more of your sort of more major questions as we go through a sort of question and answers at the end. Before we do start, if you can just take a look at your screen, we do have a risk warning for you just to quickly read through. I want to take a few seconds, but if you just have a quick read through the risk warning, and I'll be back with you straight after. Excellent. So today's webinar, we're looking at post-ESMA. So we had the ESMA regulations come in very recently, which saw quite a change to the retail accounts and how you guys are able to trade. Today's webinar, again, we're just going to cover who ESMA are, just very briefly. We're going to look at the changes that have been introduced, and we're just going to focus on sort of the main changes that have come into effect. So the leverage rates for retail clients. I'm briefly, well, in a little bit more detail, I'm going to go through sort of understanding margin and leverage and their relation. I've got some margin examples for you. I think the main sort of focus of the webinar is going to be looking at sort of understanding the account valuations and how they've changed now post ESMA. So when you do log into your Trader Pro account, you have all the numbers at the top. So we'll go through what those numbers mean and the maths behind it and how they change with positions being opened and closed. Then we'll move on to sort of risk management, looking mainly at position sizing and stops. Very interesting part of the webinar and how that goes hand in hand with your trading. Then we're looking at the 50% closeout rule, which is a new rule, a new change that's been brought in from ESMA that's in effect at the moment, just to make sure that you do understand it and how it works and how it will affect how it affects your trading. And then all these rules are based on retail accounts. You are able to elect yourself as professional if that's something you wish to do. So we'll have a quick brief look at that. And see how you can go ahead how you can go ahead and reclassify yourself. And then we'll finish off with question and answers. And I'm sure a lot of you got a lot of questions which I can read out at the end and answering them for you. So we'll have that right at the end. So let's get underway. So who are ESMA? ESMA, European Securities and Market Authority. They're like the regulators of regulators. So here in the UK, we sit under the FCA, and then the FCA sit under the ESMA, and ESMA have put out this Europe-wide new regulation, which has come into force. And now, as you all know, these new rules now will govern your trading. So ESMA is an independent EU authority that contributes to safeguarding the stability of the European Union's financial system by enhancing the protection of investors and promoting stable and orderly financial markets. So what are the changes that are coming to retail accounts? I'll briefly go through them, then we'll have a bit more of a more solid explanation over the next few slides. So the big changes were to leverage limits for retail accounts. What you've seen is a reduction in leverage, so an increase in margin that needs to be put up on a trade. The reduction of FX has gone down to 30 to 1. Non-major currency pairs, gold and major indices have gone down to 20 to 1. For commodities other than gold and non-major equity indices, down to 10 to 1. 5 to 1 for individual equities, and 2 to 1 for cryptocurrencies. 50% margin at a closeout for all on account basis. Negative balance protection, providing a guaranteed limit on retail client losses. We've got no incentives now to trade or spread bet. Okay, so they are the changes. So they're the major changes that have come into effect now. Just quickly, go through the biggest change you'll see on your platform on the retail account is this leverage. So again, major indices 20 to 1, major indices 10 to 1, gold. Major indices 20 to 1, gold 10 to 1, commodities 10 to 1, equities 5 to 1, and you've got your cryptos down at 2 to 1. What does that mean? So what do these numbers actually mean? Because a lot of people seem to understand this number, but maybe a little to sort of not too understanding of how it affects your trading and why they actually have these numbers. Let's look. So margin, when you put up margin, when you place a trade, a margin is a deposit which is used to open a position. With ourselves, you'll notice when you have a look what is the margin rates or for a particular contract, they're expressed as a percentage, and then these funds are deducted from your TFA, also known as your trade funds available. So when you're on your Trader Pro platform, up in the top, when you see your account valuations, you've got a TFA section. That's known as your trade funds available. When you open up a position, a new position, you'll see that the margin which is due on that position, needs to be sort of withheld or sort of segregated from your main balance, that comes out of your trade funds available. Why that comes out your trade funds available and what your margin is just to ensure you cannot over leverage your account. Okay, without it coming out of that TFA, you could just endlessly open up trades. And what this does is when that TFA gets down to 0, it's basically saying you've got enough positions open, or you've got a big enough positions open in relation to your account. So that's what it means. It doesn't mean anything else apart from it's stopping yourself from over leveraging on your account. Your margin should not be confused with your trade risk, and I'm going to emphasize that quite a bit throughout the webinar. When you see now, but before when you had a £40 margin on, say, a particular index, and now that's gone up to £400, that's not £400 on your risk on your trade. You weren't risking £40 before, you're not risking £400 now on your risk. There's two different things. What it is they've brought in these new rules just to make sure you can't over leverage yourself on your account. You can't keep opening massive big positions which would see sort of your account sort of be exposed to a loss very quickly because of the nature of the size of your position. Basically, they've just increased what needs to be put down, what needs to be segregated, just to sort of slow down and make sure that you can't just continue to open up these big positions. So your margin should not be confused with your trade risk. They're two different things, and throughout this webinar we'll cover these in a lot more detail on what I mean by that. So if you know your margin, you can calculate leverage. They go hand in hand. So when you saw those leverage rates sort of 30 to 1, they're in relation to the notional value of your trade. So for every pound you put on, you can be leveraged up 30 times. So if your notional value is, in the hundreds of thousands or tens of thousands, you can quite simply divide it by 30, and that's what your margin is going to be. So you can, if you know the margin, you know the leverage is, they go hand in hand, the same sort of maths. We just a different way of doing the maths, and they can work out. Just a quick sort of explanation really on where you'll see how the margin, and where you see the margin on your tickets, and where you see the margin information, and just a very brief sort of explanation on how the calculations work when you open up a ticket. So here we've got a position in, I believe it's GBP USD there. And so you'll see if you're just doing a one lot there, your margin will come up there. It just quite simply show underneath. That's £432. Way we calculate the margin, is if you want sort of more information on margin, you can actually click on the information tab, and it will display there what the percentage margin is on the notional value. Okay, so as you can see there, press information, you've got 3.33% up to a certain amount is a tiered margin. If you open up a position that's starts getting a lot bigger than that, then you'll be subject to a bigger sort of margin. But yeah, 3.33%. That basically works out as 30 to 1 on your leverage. Way you calculate your margin on positions. So what you're going to be needing to understand is first your entry price. So on this, if you have a look at the example now, entry price there would be one spot 29,465. Then you need to understand the tick size of your particular market that you're trading. Okay, when it comes to FX, it's based on the full decimal place, 0.0001, and it's not the same for every market. In FX, it's pretty much the same, apart from sort of yen-dominated pairs. Then you'll be based on the second decimal place, and then other sort of markets such as indices, it's just based on the whole number. And then there's a few commodities where it's based sort of on different sort of denominations. We've got a great spreads and specifications section on our website, and from there you'll be able to see where the ticks are. So I'll show you during the presentation on where you can go and find this information. But for this particular example, we're using a tick size of 0.0001, and we've got a volume of 1, nice and easy there. We find out what the margin rate is, as we can see from the as we can see from here, we see the margin rate there, 3.33%. And what we do is the notional value. To work out the notional value, we take the entry price, which is one spot 29,465. We divide it by the tick size, 0.0001. That gives us the how many sort of ticks there are, which goes down to sort of the 0. So that's basically how you work out your notional value, and you times that by the volume. Okay, so entry price divided by tick size times volume. Now we've kept it simple here, so it's 1. So you can actually just do entry price divided by tick size. But if that was more than 1 or less than 1, there you'd be times it by the volume. That gives you a notional value on this particular trade. So if I'm buying a £1 a point spread bet there on cable on GBP USD at one spot 2946.5, my notional value is going to be £12,946.50. So that gives you total notional value, and then we're going to take the margin rate, which is 3.33%, and we'll get the we'll get that 3.33% of the notional value, and that gives us our margin. Okay, so it's quite simple there. That's how that's calculated. That's how that's calculated for that particular market. It's not a terribly difficult calculation, but it just gives you a good idea of how we come up with margin and how you can do it yourself. A few more examples then. Now we take a look. Sort of if we use gold, here with gold, we got one spot. We do an entry price of 12.07 spot 5, and the tick size on gold is 0.01. So each point as it ticks up and down, it ticks in 0.1s. That means you're onside by 1 or offside it as every time it goes up by 0.1. Again, we just use the normal size of 1 here, and then that gives you a notional value of 12,075 times 5%. That's how you get £604 for a £1 a point in gold. Germany 30, as mentioned before, with the indices, the point is actually based on the whole number. So every time that whole number there, so in that particular market there, 12,646, if that moved up to sort of 12,647, 12,648, that's each time based on your volume, you'll be making a pound a point, and obviously if it went against you, you'd be losing the pound a point there. So 12,646 spot 7 divided by 1 times 1. Obviously, you can see that's an easy calculation to work out. 12,646.7 times it by 5%, you get £633. Okay, and that's your margin due on that particular position. Brent crude has a tick value of 0.01, and that gives you 7,419 spot 6. 10% is the margin requirements of Brent crude, so that gives you £742. Cotton 87 spot 72. Cotton trades tick size at spot 01 as well. It's very similar to Brent crude. That gives you 870. That gives you 878 margin there. Do note the margin, they just round it up. They don't have the decimal places there. They just round it up to the next pound. Wheat. I've done a half a volume here, and if you notice with the tick sizes in wheat, actually it's not quite different to the other markets where it trades up and down in quarters. Spot 0, each tick is actually 0.25 of a dollar, based on the wheat price there. So if we were to work out the notional value of that particular trade, we'd take the entry price there if we were going to buy at 567 divided by spot 25 times it by the volume 0.5, so that gives you 1,134 times 10%. There you go, you get your margin at £114. And just a quick one on Vodafone now. I know there's quite a lot of calculations here, and I'm pretty sure you're getting the picture. 188 spot 13 divided by 1, because Vodafone and all UK equities, they trade up and on the whole number, that's a point, times 1. That gives you 188.13 times 20%. That gives you a margin of £38. Okay. As mentioned before, you can go to our website and find out all the information on how these tick sizes and what the new margin rates are. Just go to etxcapital.co.uk. If you click on the spread betting, you'll be able to get to the spread and specifications, where you can just sort of scroll up and down, go through the spread betting, CFDs, Trader Pro, MT4 platform, have a look at the tick size and what kind of margins that are now need to be made on each trade based on the new ESMA rules. Okay, so now I think one of the most sort of important parts of this webinar, I think, is sort of getting an understanding of the account valuations. Okay, and if you're not sure what I mean by account valuations, it's the top part of when you log into your platform. Okay, you'll see at the top there, you'll have like six different headers, all very important, and you need to sort of understand what each one of those means. Let me go through each one of them now. So your balance, this is your realized cash balance. So you got your cash, and every time you close a particular position, it will be deducted from this pot. Okay, so that's your realized cash balance. Profit and loss is your unrealized combined profit and losses from your open trades. So all the open trades that you've got on open at the moment, you're going to see them sort of ticking up and down, the price going up and down. You're going to see that in that section. Your margin, which is your current sort of reserved margin for all your total open positions. So when you open positions and you've got live open positions, that's going to be the total margin that you've got sort of as your buffer. That's what you need to put up to keep those positions open. Your margin percentage, this is what we use to compare what your margin is reserved, your margin you've got up on all your trades against your equity, which is your live sort of cash, your live sort of balance, taking everything into consideration. We generate a percentage from that, and that's what we use for the 50% closeout rule. I'll explain that. We've got a nice few sort of slides where we'll go through that in a lot more detail. Equity. So okay, this is your live account balance, the most accurate reflection of the current state of your account. So this is probably one of the most important, part that you'll see. This is what your money is looking at the moment. This is taking into consideration your profit and loss and all your margin in there. So if you were to close all your positions now, liquidate absolutely everything, that's what you would be ended up with. Okay, so definitely the most important part out of all of them. And then your TFA is how much funds you have left to open positions. And again, that will go down as you open positions, and it's just there really to stop you over leveraging yourself. And that's once that gets down to zero, that stops you sort of open up more positions. And that's really what these new rules are geared towards doing, just protecting your account from taking on too much sort of large size, too many positions, which that could go against you. So it just kind of makes it a little bit easier for you. Going through a few more examples now. I think what we'll do now, we'll take a look at what happens when you actually open a position and just see what actually happens to these account valuations as you open and close positions. I know I can see a lot of people, see the positions opens and they see all these numbers down. So basically, we're going to see what actually happens at that instance when a position's open, pause it, and we can see like just how the numbers are affected. I can appreciate in real time when you're doing this, you open up sort of multiple trades, or it's going up and down very quickly, and the market's moving all over the place. You see all these numbers moving, you kind of can't really grasp what's happening there. But now just take a look at just opening position, what happens, and what happens to those account valuations. So I've got a ticket here using that example that we used in the sort of first couple of slides of the GBP USD. So what I'm going to do now. Open the position, press buy. So we bought at one spot 29.46.5, £1 a point, and we got our margin at £432. Okay. Now this all these account valuation I've done at the moment is just based on a single trade. We'll look at multiple trades next, but this example where this is the only trade that's open, it's live, and you can see in this particular example here, we've opened and we're about £10 on the side. We can see a P&L of £10. Okay, this is what your account valuation will look like just after the trade has been opened. Okay, so you can see your balance, P&L, margin percentage, your equity, and your trade funds available. So let's have a look and see what's changed here from looking at that earlier example where we had no trades open to what's happened here now. First thing is obviously your P&L. So I've got a profit and loss of £10 on that particular trade. Now that's reflected in the profit and loss there, as you can see, £10. Next thing you see is the particular margin on this position was £432. Again, that gets calculated in your margin section here, £432. What will happen now is that £432 will be taken out of the TFA. And now that's not a risk here. That's not £432 at risk, and what you're risking on this particular trade. That's just stopping you from, keep opening and opening positions. What you can open up is in direct relation to what you can have in an account. So this basically says to me, okay, well, I've actually still got £2,199 to play with. So if I wanted to sort of open up more positions, I'm happy to do that. But until that gets down to sort of the zero sort of area, that TFA there is calculated by taking your equity. What your live equity is, there you can see your equity, because that equity includes my profit and loss, my running profit and loss, and as I said before, that's your more sort of true number, and taking off the margin there, and that's what's got that to that 2,199. But yeah, again, that's where the equity is the main one. That's the one I'm going to focus on now. That's what I'm going to see. That's going to be a live update on what my balance is, what my cash money, what I've got in my account. So if we now know that the margin that you're paying on you're placing on the trade is to do more with not allowing you to over leverage your account, but it's more to overload and not to do with the risk. How do we sort of manage risk? How do we manage our downside? So we protect our capital and so on. The basic sort of essence and fundamentals of trading. Let's before we do that, sorry, let's take a look quickly just at sort of open up some sort of multiple tickets, and we'd have a look at a bit more of what the risk management is. Here we've got an example. If we just continue from opening up the single trade to now looking at opening up sort of multiple trades and how that actually affects the account as well. So if I've got the first trade there, my cable trade I was taken from the previous slide. Now, if I start adding trades to my position, can you see what happens? So I've added a Euro USD position there. We've got a margin of £385.85. All we've got really there P&L is what we'd pay on the spread as we're open. As we instantly open the trade, would be slightly offside because of the spread. You can see that our profit and loss has slightly come down from the P&L, and then our margin is starting to increase, okay, as we're adding positions, and you can see that TFA coming up. So that's basically saying, okay, you got the TFA to open up funds. It's this margin is not what you're risking on a particular trade. It's just that's going to start coming down as you just open up more sort of positions. But the main thing to focus on really here would be your equity. That's staying similar. That's taking into consideration now what your live P&L is. So you're seeing a small sort of drop, but as the new trades are open up, your TFA is getting more and more down to zero, but your equity is staying the same, and that's going to reflect what your open positions are. Okay, so it's now up to the trader to sort of apply the risk management to their trades. And sort of protect the downside and sort of calculate where they're looking to, well, in case positions do go against you, where you're happy for it to sort of cut out and not go any further. Now, to do that, what we use is real basic sort of risk management strategies. There's, like I said before, they're fundamental to trading. The actual employing sort of just the basic sort of tools will go a long way in your trading. If you can just protect that downside, understand what it is, understand your capital, and understand you need capital in order to continue in this game and to place trades. So employing basic sort of risk management will go a long way in your trading. So managing risk helps you understand your downside and protect your capital. The two main components of risk management involve using tools to limit your losses and effective position sizing to get the most from your trade. The most basic and easiest tool to use on each of your trades is a stop. That's the most, I'd say, is the most basic risk management tool. So on ETX Capital, you can sort of set a stop that will take you out of a particular position if the trade trades against you by so many points, or if it trades a particular level, or hits a particular downside in your P&L. You can have these positions exited for yourself. Your risk can be calculated by looking at where you place your stop and the size of your position. Okay, that's known as sort of position sizing. So two very important tools there would be employing a stop and using position sizing on your trades. Traders place stops at places based on a number of factors. The most popular include a technical level or a monetary level. So when traders actually place stops, there's obviously a number of factors what they use, but the main two really what they look at would be, is there a technical level that would, there's a technical level that if it breaks would suggest that the position is not going in your favor anymore, and it may suggest that it's a time to exit position because like I said, the market's no longer trading in your favor. Or a monetary level is a particular point in your account where you would like to exit and say, okay, that's enough now on that trade, let me protect my capital and start to move on to the next position. So if we take a look at how monetary sort of levels are calculated when employing a stop, And again, we use an example that I've used before. We've got an open position in cable, and as you can see on the account valuations, that does reflect this. A lot of traders like to take a look at certain levels of percentage risk on the account, and then that's how they look to calculate where they place their stops, and what level they place the stop based on what that percentage downside is. So if we have a look here, we based this percentage downside on the actual cash balance. So when I opened up this trade, I knew my this particular position, I knew my cash balance was 2,621. So if you start looking at sort of calculating 0.5% of the balance and think to myself, okay, I'd like to risk 0.5% on this particular position, just based on the one lot. Okay, we know that our downside would be £13. That's what 0.5% is of 2,621. And then we could start to work out how many pips away that is. So we look at our downside and just divide it by the quantity, and that'll give you pips. And then when we put on our entry, we take away how many pips it is, and that gives us our stop level. And then if we take a look at 1% risk, that's double there, £26 on £26, 26 pips, very easy there on these particular answers. So we put a stop level, our entry where we got in, minus our pips. That gives us one spot 29,205, 2% risk there. Downside £52, 52 pips, and then we have a stop level entry minus our pips. So we know that's what our risk is going to be on the trade. It's not going to be what it is the margin. That's because that's completely separate. That's to do with stopping us level. Now we're looking at real risk based on particular positions. Where we calculate where our stop is, we got a good, that's where positions will be stopped out, and that's going to be the risk on our trades. So we employ that on all our trades there. So all our open positions, we have a good idea where our stops are going to be. We have a good idea what our risk is going to be on that particular trade. So we can look to, possibly open up more trades. So if we had £1 a point there, knowing that we had 2,199 in the account, trades around the rails, if we think to ourselves, okay, I could take on a little bit more risk here, I've got a lot more to play with, we just take a look at TFA and we had to work out, okay, I've got the funds in here now that allow me to to open up more positions, take on more risk, even extend the stop, add to positions. I can do that by knowing, okay, I've got my risk sorted out and I've got the trade funds available to open up more positions. Okay, so if we take that last example there of £52, we will see position will stop out at the price trades at one spot 28.94 and a half. Okay, so we're using this last example here, and we've got our ticket here that we've placed. So we've ticked the stop button, we put our level in, or we put up here now. We can put a point. So you can actually choose either one of those. You don't have to choose all three. If you change one, it will automatically change the other. Depending on market volatility, the loss will be around £52. Don't forget, there are sort of factors here that can affect your stop, such as slippage, positive slippage, things like that. But but based on market volatility, we know if we've got to stop in around there. And if that price is traded, our platform is going to execute our trade at market and exit our positions. The 432 margin is then added back to the TFA. So as soon as that trade is stopped out, that 432 goes back into your margin. So you'll see that 2,199 jump back up to where your equity is. If that's the only trade open at the time, your TFA will jump up with where your equity, because the equity is going to start taking into consideration the loss in the trade. So the risk in the trade is £52, not £432. Okay, so they're two very separate things. If you can sort of understand that, then as I said before, you can look to sort of add to positions, trade very differently, look to sort of add to winning positions, things like that. The very different ways of trading that you see fit. If I look at position sizing now, as I mentioned before, so you have stops based on monetary. Now, another important tool is understanding position sizing. So this is sizing a position based on your it's based on how you calculate where your entry and your exit's going to be, and then having a certain risk attributed to that. Okay, so let me explain. I'm using a chart here. I've got a Germany 30 chart. Myself, I've identified a downwards moving trend resistance, and I've also identified an area of resistance that's seen a breakdown, and also if it's touched it, I've seen it actually hold there. So a little bit of technical analysis here. Feeling a bit bearish because I've seen this trend resistance. This trend resistance touch, and it's coming off. So I'm feeling a bit bearish about the Germany 30. I've identified the two zones here. Like I said, I've got a downwards trend resistance and I've got a resistance zone. So I've got the downward trend resistance and I've got our trend resistance zone. And you can see prior to the big breakdown, we were holding above there, nice bit of support, and then we had a lot of price action before that, before we broke through, and then we've come up, we've touched it before, we've got quite a few times, and we've bounced back off again. So in terms of that longer term trend, that would indicate a trend change if it broke. So in thinking now, okay, I'm bearish on this, I'd like to get into this sort of market here, but if it was to start moving above the trend resistance and the trend support, I'd think to myself, okay, I think this trade's no longer going in my favor. It's broken through some key sort of areas of resistance. That trade's no longer in my advantage. So I've got trend resistance at 12,707, an upper trend zone at 12,766. So I'm looking to possibly do a short position where the trend resistance is, and looking to place a stop loss, up in the zone where I just think if it trades up there again, it's gone through all my analysis. No trade's no longer in my advantage. Pip difference there, you're looking around 59 pips. So now I would look to sort of size my position. Sorry, I look to size my sort of risk or my position I'm placing per point to sort of match this now in terms of my account balance. So example I've got an account balance of 3,000. I've got 1.5% risk, which is around £45. So, and I'm thinking to myself, okay, well, I've got the 59 pips there. If it goes through those 59 pips, that's going to be my sort of buffer. If it could trade through all of those, then again, positions are no longer my advantage. Divide the risk by your pip difference, you get set 0.7 per point. So I can risk 0.7 per point, which is about 70p per point. If it goes through all of those those 59 pips, that's going to be a risk of £45. Okay. So I think the total exposure works out around 41.50 based on the volume increments of 0.1. So you can have 0.7 on. So that's how you can work out in terms of position sizing. That's how you can have a look and see, okay, I like this entry here. I can see the technical break here, up here. That means no longer it's my advantage. No longer my advantage. I can sort of size positions around based on that sort of volume and per point. Margin of trade is actually 445, so I'd see that taking out my equity, and the actual trade risk is around sort of 41.50. Okay. If I'm employing a stop there, so you can see what the differences are and how sort of position sizing is a great tool, a great sort of methodology for sizing up your positions. In relation to sort of how much you're prepared to lose on the account, where you see a good entry, good technical entry, and where you see a good a technical break, which moves, which goes against, which means your position is no longer valid. Just a quick recap then of sort of the risk management, what we just mentioned there. I'd say focus on your total equity. As I mentioned before, this is the cash available to you if you close all your positions. Okay, so that equity includes your total exposure plus P&L. Sorry. Focus on your total equity. This is the cash available to you if you close all your positions. Your margin has increased, but your risk has not. Sorry guys, I got a terrible cough. Your margin has increased, but your risk has not. Okay, so the increasing of your margin is just, again, as I mentioned before, is just the leverage. It's just preventing you from over leveraging. the actual risk on your account is still based on your positions. Your risk is directly affected by where you place your stops and how you size your positions. And your different, so your risk is directly affected by where you place your stops and how you size your position. The different strategies you have sort of different risk profiles. So this is another interesting thing in how you look at your markets. They kind of fall down into three different sort of areas. You got intraday, swing, long term. They kind of categorize a lot of how people trade the market. So an intraday trader, it's sort of guy who trades on sort of the intraday sort of time frame, some very low, sort of few minutes up to sort of the half an hour sort of positions. And you've got the swing trader who likes to take a a strong sort of support level up to a strong resistance. And then you've got the longer term trader who will go on for a good, a swing trade could take a few days, a long term could be sort of post few days, and going for more than 2-3 days. So when you're sort of doing your risk based on those three, it's very slightly different. If I start from sort of long term to swing, a lot of your capital is going to be tied up, isn't it? If you're putting on a position, because this comes out of your trade funds available. So if you're holding a position, just think to yourself, okay, what's the margin on this? Because this is going to tie me up from opening up more positions, essentially, and it's going to it could put me out of sort of trading more shorter term or open up more positions, because I've tied up in capital for a long term. And especially with a long term position that goes offside, if it goes offside and then you're even more tied up, you're trying to wait for this to come back, so always think yourself like doing position sizing and you think to yourself, okay, if it's long term, how much of my capital do I want tied up? Because I want to, if I want to get into sort of intraday and back into sort of shorter term position and have funds available to trade. And then with sort of intraday, you think to yourself, okay, well, I'm only in and out of these sort of positions here. It's not like I need the trade funds available to be tied up for other positions. So I know that with sort of intraday sort of trading, that sort of TFA is not too much on my mind there, because I'm not tying up position at funds for long. So different strategies have different risk profiles. Just be conscious about how long you're putting positions on and how long you're holding these positions for. Longer term trades may tie up capital needed to open shorter term trades, as I mentioned. So equities, a lot of people like to hold equities for a long time. Just think to yourself, okay, now we've got a 20% margin on equities. How much of my account am I actually going to tie up, and which will prevent me from sort of opening up other positions. Another good sort of tool really is using sub accounts. You are able to open up multiple sort of accounts on your profile. If you want to sort of keep one TFA for longer term and then have a TFA available for shorter term methods. I think just really the most important risk management sort of bit of information I can give anyone, from days when I was a trader, when I was a futures trader, and this one was just always driven into my head. And it's a lot it's a lot easier than it is, but ride your wins and importantly cut your losses. You've got to look at ways to cut those losses in case they start going against you quite heavily, and that's employing sort of the basic risk management tools that I mentioned there. So using the stop, using the position sizing, using stop and using the position sizing, they go hand in hand with managing the risk on the account. Okay, that's the risk management section. If you've got any sort of further questions on there, just please keep typing them into the question box. I'm going to get on to answering some questions very shortly. But do keep coming in. Anything about risk management, anything I've said there, anything new you'd like to take into further information, just keep putting them onto your question box. And like I said, we have a bit of a question and answer when we get to the end. Let's just cover the 50% closeout rule, because we've covered the percentage we've covered the margin percentage which the account is based on in the account valuations. You receive an email notification if your account equity drops below 100%. Okay, so that percentage box that you see on your Trader Pro, if you can't see that percentage, you can just need to make your screen a little bit wider. You'll be able to see it. If it drops below 100%, you're receiving an email notification. This is just to clearly state that you're below 100% and just a little bit of a reminder to keep an eye on things, possibly take the funds up if needed, and just to let you know that you may be in a position where you're close to the 50% cutout. Okay, so your position's not going to be cut out till it gets to that 50%, but below 100%, just a little friendly warning there for yourself. If you're an empty field, you don't get the warning, you just get a yellow sort of warning, a yellow sort of flash up in your trade terminal. As soon as your account equity drops to 50% of the minimum required, under the new rules, we will immediately reduce or close your positions until your account equity reaches 100% again. Okay, so if your percentage gets down to 50, so if your equity, so that's the equity section in your box, gets to 50% of the margin, so whatever your margin, I think an example before we used 400. So if my equity gets down to 200, that's when positions will be cut out, and it will take you back up to the 100% margin again. So we'll close out positions to take you back up to the 100%. A little example here for you. An open trade has a margin requirement of £500. If the TFA falls to 0, that is the 100% margin call. As you see in the moment, we've got a balance. You see the profit loss at the bottom. There you see it's negative 250. Position's gone against us. We've got a margin of £500, but we had a balance of 750. So you take your 250 equity, it was 500. So if it reaches 100%, which it is there, that's when you're going to get the first email, just to let you know, okay, you've fallen below the 100%, and it's time to take a look at the account. There is a possibility here that this could continue to go against you, and you'll get down to the 50%. So that's where position going up here. So your TFA is 0 there. You've got no more funds there available to open up funds on the account. Okay, to open up new positions on the account. Okay, so TFA 0. You just got these positions open. Okay. When the TFA falls to minus 250 or equity value is reduced to 250, 50% of the £500 margin, your positions will automatically close until the back above the 100% required margin again. So to take it back there, we're negative 250. We've got the email now. It's come through. So it's 100%, and now we're watching our positions. Position continues to go against us down to 500. Okay, so you can see it's a negative 250 TFA. Equity is only 250 now because it's a balance, 750 minus the 500, and that gives you the equity of 250. Okay, that's when you're going to be automatically cut out, and it's an automatic cutout for the retail clients in line with the ESMA regulations. Okay, so that's when that's happening. I hope that sort of clears up when you get a good understanding, on how that works. So that's the 50% closeout rule, and it's the same on an MT4. So you don't get the warning on 100, you just get the yellow warning in your terminal, and it will just automatically, as soon as it's touched, just cut positions back up to 100%. Okay, and as mentioned at the start of the webinar, these changes are just for the retail clients, but you can elect yourself with professional, and that if you feel that it's something you want to do and you do meet the criteria, then you can elect yourself as a professional reclassification, and that takes your margins back up to sort of previous levels, and changes a few things. You do lose a sort of bits and bobs there of sort of protection and things like that. This is all we can all provide you this information. But in relation to MiFID or equivalent third country business, in the course of that assessment, at least 2 of the following criteria are satisfied. The client has carried out transactions in significant size. on the relevant market, and average trade frequency of 10 per quarter over the previous 4 quarters. So if you've traded in each of the last 4 quarters and you've done at least 10, and so last at least 40, but trading each and of a significant size, then that's the criteria you can pass yourself on. The size of your financial instrument portfolio, that's cash deposits and financial instruments, exceeds €500,000, so 500,000 euros. If you got that and you can show documentation for that, then you that's another sort of criteria that you can pass yourself on. And the client works or has worked in the financial sector for at least 1 year in a professional position which requires knowledge of transactions or services envisaged. So what really that means, if you worked in a position or within a company where your position is related to sort of capital markets, trading, leverage trading, risk on markets, if you're exposed to sort of trading, then that's something that you may be able to pass yourself on as well. What you need to do, you need to meet 2 of the 3 of those criteria, and if you can meet 2 of the 3 of those criteria and you're happy to provide the supporting documentation, then it's very much there's a possibility for you to reclassify your account. And as you can see there, the difference in the leverage between sort of retail and professional. So retail indices 20-1, professional is 200-1, FX 33-1, professional 200-1, equities 5-1, professional 20-1, gold 20-1, professional 200-1, Bitcoin 5-1, professional 2-1. I think that's the other way around there on the Bitcoin. Yes, it is the other way around. So you get 5-1 on professional, and 2-1 on the retail. Okay, so like I said, if it's something you want to do, if you're happy to sort of it's a route you want to go down, you want to be treated as a professional, there are obviously there's a method to doing it. First of all, you need to get in contact with myself. That's Michael Baker. You can email me or you can phone call. You give me a phone call for a chat, and I can talk you through the process, or you can talk to our customer service. Okay, so both our details there are on the screen. Be happy to take your call or your questions. And that's not just on professional, that's on any of my presentation today. And I think that brings us to sort of the question and answers now, where I'll be happy to take any questions you've got left for me on sort of the ESMA regulations. Anything you want to say to me, anything you want to sort of point out, any sort of statements you want to make, just please type them through in your questions, and I'll be happy to read them out and give you an honest answer. Absolutely anything. Okay, here we go. Is there a warning for the MT4 terminal, and how many time is left for me to choose the trade to close? Okay, Reese, what happened with the stop out on MT4? It will stop out your biggest risk position first. So if it gets down to if you're on margin call and it's about to touch the 50% or go below 50%, MT4 will cut out the biggest risk first to take you back up to 100%. That's how it works. Steve, thank you, very informative. No problem, Steve. Barry, thank you. Michael, no problem. Apologies for my cough. Be honest, it's a EU or UK regulation. This is EU. It's ESMA, European Securities Market Authority. So any broker in Europe that holds a license by their regulators that fall under ESMA are subject to these new changes, to these rule changes. Okay, so if you do find that you are being offered by someone else, take a look at the regulation. Are they regulated? Because there's a strict protocol now for all companies in Europe. Andy, Stuart, how does this relate to MT4? It's exactly the same. It's 50% cut out, and I suppose my sort of presentation was on a lot more towards sort of Trader Pro, but understanding in MT4 you have the same sort of categories. You have margin reserved, equity as well. So just pointing out with sort of your margin reserve, it's that's not the risk on the trade. A lot of people think, okay, because it's gone from £50 to £500, that's not because I'm not putting on an extra £450 risk here. It's just that from opening up more positions, I'm tied up a bit, so I've still got the trade funds available there, to manage this position or to open up further positions. Yeah, anyone registered to Craig, can I get a recording? Yeah, anyone registered to today's webinar, you'll get the recording. Stacey, I missed the first part where, yep, I'll send over. Everyone who's registered will get a recording. I was present. How can I get to see the recording? I'll send it over a link. Colleen, is ESMA regulation likely to change again after Brexit? It's a tough question. Brexit, there's sort of the start of the withdrawal starts next year. There could be a lot of transition periods. I think one thing to notice that FCA were always keen to sort of to change the way this particular industry operates. So, you do have FCA, which are a world-class, world-respected regulatory service. So I don't imagine them climbing down too much, but who knows? Yeah, but who knows? We'll have to see. But as it stands, for the foreseeable future, we are bound by these rules, so it's something you guys will have to get used to. And I, based on how I've explained it today, I think everyone will be just fine. Norman, so after Brexit, the rules are defunct. It's as I explained there, it's I don't think it'd be as straightforward as that, but we'll have to see. Cordelia, thank you. I have a better understanding now of how the new regulations will be applied. Not a problem. Any further questions, drop me an email or a phone call. Bafana, how does MT4 compare to Trader Pro? MT4 is a standalone Windows application that goes on your PC, so you have to load up the application, whereas Trader Pros are in-house, our own design trading platform, which is available through a browser, so you can access it a lot more conveniently, as it has its own app as well to go with it, and it's all down. I mean, it's down to the trader. If you're looking for sort of tighter spreads and things like that, then you'd be going down the Trader Pro route, and if you're looking for convenience of a platform, and you just want to open up on your browser, have a nice sort of fast execution, things like that, then you'd be looking at the Trader Pro platform. Ian, do you have a lot of questions on whether Brexit? I mean, all I can say is that, as before, FCA is a very world-renowned. A lot of people, investors around the world, would want to invest in UK because of the FCA and how stringent it is. So if they were looking, they put out their own proposal. Sorry, they had their own proposals as well before ESMA come up with their own ones. So, to think what the step back it was, they were a little bit more lenient on leverage. So it's a possibility that if they were to step back a little bit, then it could change a little bit. But for the time being, guys, it is what it is at the moment. I can't see, and it could be a case now with Brexit. We have a long transition period and things like that, and services or the financial services could still be tied up with European institutions. So it's a big if, but it's a long way away. So yeah, wonderful webinar, Michael. Thank you. Glenn, as a retail trader, what is the smallest account size that you would recommend trading? I'm sure the smallest deposit ourselves is around £100 or $100. I'd always go straight onto sort of a live account. This is my personal opinion, with using sort of the smallest sort of trade size, and get yourself used to sort of the risk that you can sort of generate, and sort of seeing your P&L go up and down and things like that. A lot of people like to use a demo just for functionality, but actually getting your head around seeing your account lose money and make money, it's a totally different ball game. But start off small, then just gradually increase your risk and take your size up to match that. Just got to understand, all the risk involved and understand what you can generate. It's totally down to the trader, but it's good to start, get involved, use sort of live funds, and really get a feeling for those sort of emotions, those things that go through your head when you see a nice P&L and when you see a negative P&L. It's you can't really replicate that anywhere else. Reese, thanks for the answer. If I'm in the end of a solid margin and then he opens a position, if you've still got trade funds available, Reese is asking, will a robot still open positions up if you're end of a solid margin? Yeah, if you've got no trade funds available, he can't differentiate between yourself and a robot. But if you've got trade funds available, then it will allow you to open up positions. But if you don't have trade funds available, then your robot it'll just get a rejected message. So that's what a TFA is. I mean, if you've got £500 worth of TFA left, you can open up a position of £500, or you can open up small positions. And you get to the point we've opened up so many small positions that you've only got a few quid left. If that position only takes a few pounds to open up a position, then it'll allow you to do that. But it's there. This is a very rigid rule. It's not interpretable in any way. It's have you got the trade funds available to open? If so, yes, it'll open. If you don't, it won't open. It will just get rejected. Thomas, thank you, Michael, for an informed webinar. It has helped to clarify some aspects of the new rules. Tom, not a problem. Peter, it seems to me that new ESMA regulators do little to reduce the number of loose trades, it just slows them down. It takes them minutes. Not sure that who that all helps really. Well, I think it just stops you, hammering through your TFA and open up in a huge position where, if it goes against you by a good few pips, you're going to see a large dent to your equity account. I think that's what it's there for, and it can only be a good thing if that, if it's really really getting you to focus now a lot more on what your notional value is. What is the margin down? What is it that you're actually, what the risk is you're taking on board here. I think it's really homed in on that, so that can only be a good thing. I think if you're a lot more concentrated on your risk, because it is a risk game, isn't it? It's, you've got to be an unbelievably good risk manager to do this. So I think it's a good thing. People are unhappy that maybe it's come down so much, but these rules are here to stay now, and it's just a case now of just sort of adapting your trading, and it'll be the norm in a couple of months. We'll be talking about the days where you could sort of take on those sort of large positions, but now it's just a lot more risk focused, and I think that can only be a good thing for people with accounts. Okay, good. John Davis. Sorry, John, I got the question over quite a few different spots, but I think one of my team members, one of my colleagues, is answering the question. So I'll leave that there. Just a few more things now, just to sort of things that we're asking really, what we're looking for from you guys. Have you got a sort of chance there? Is it, with the new rules there, sort of pre-webinar, post-webinar, sort of me explaining the sort of changes and post sort of changes, was anything sort of that was holding you back from your trading now because of these new rules, and maybe you didn't understand them? Do you think any of these changes have affected you? Has these changes, have they impacted your trading, your strategy, and do you now understand sort of margin and account valuations? So if you're on here, the webinar now, we've still got a ton of people still on the webinar, so if you could be great if you just answer those questions more. I think in terms of what's holding you back, I just want to know really, with the new regulations when they come in, sort of pre-webinar now, after webinars, it's something a lot more clearer now. Has anything changed for yourself now? Really, did you have, were you stuck between did you have a is your understanding now sort of margin that goes down on the account and the risk that you're taking out on a particular position? you know, as you understand and change that now, do you see things different, or were you familiar with that? So it'd be great to get a little bit of feedback from you guys, and a bit of feedback on how the webinar went. Again, apologize for my cough there. It just come a little bit come on a little bit strong halfway through the webinar. I think when I'm rapiding on quite a lot, it just got me at the back of the throat there, but I think everything's okay now. So if you've got any questions, or if you can just answer that those questions for me, great, and let me know how things went. It'd be a great bit of feedback for me. Quick question I got from Ian Hunt as well, which I must say: how much capital can you have? How much capital can you have in your account for it to be protected against insolvency? So FSCS protection from a regulated broker, because if they're regulated like ourselves, it's 50,000. So 50,000, but you know, funds are actually segregated with ETX Capital. They're sort of placed into a trust, so you know, all your funds are segregated. So in an unlikely event, you know, there are all your funds that you place with us are segregated if you're on a segregated account. So FCS, where it allows 50,000, but ETX said the funds are segregated. They are held differently from sort of company funds. Yeah, I think the general sort of feedback getting here is you know, the new rules were a bit of a change, but going forward, you know, they can take them into consideration. You know, they have to go by the new rules and adapt that to their trading, which is great to hear. But any feedback you got, guys, on the webinar, please do drop that into my question box. I'm gonna close up shop now. Any further questions at all, you can get me michael.baker@etxcapital.com. Thank you so much for coming along to the webinar, and I look forward to speaking with you all very shortly. Thank you very much. Have yourselves a great day.